There's a strategy that, quietly, has built more middle-class wealth in America than almost any other. It's not in the books most financial advisors recommend. It's not taught in the seminars. It's not part of the retirement planning software. It doesn't generate commissions, fees, or subscription revenue for anyone, which is exactly why you've never heard it explained clearly by someone whose job it is to give you financial advice. But the Americans who've used it quietly, patiently over 10 or 20 years are the ones who retire in ways that surprise their neighbors, the ones whose retirement math seems better than it should be, the ones who somehow, on ordinary incomes, end up extraordinarily comfortable. Let me show you the blueprint, because the entire financial advice industry is built around one idea. You work, you save, you invest, you retire. That's the model. That's what they teach. That's what their software calculates. And for most Americans, that model alone is quietly insufficient. There's a second lane, and once you see it, a lot of other things start to make sense. Let me explain what I actually mean. Because if you're hearing second income and picturing driving Uber on weekends, you're picturing the wrong thing entirely. There are two fundamentally different ways to earn money, and the difference between them, compounded over 20 or 30 years, is the difference between a comfortable retirement and a generational shift in your family's financial trajectory. The first way is trading time for money. This is what almost every American does. You show up somewhere, you perform some work, and at the end of a week or two, someone gives you a paycheck for the hours you contributed. This is employment. It's honorable. It's necessary. It pays the bills. But it has one fundamental limit that almost nobody names clearly. When you stop showing up, the money stops. Your salary doesn't wake up on Saturday morning and generate more of itself while you sleep. Your job doesn't compound. Your hourly rate, your annual compensation, your bonuses, all of those require your continuous physical and mental presence. Take a month off, and your paycheck stops. Get sick for a year, and you're in financial trouble. This is the structure of wage work, and it defines how most middle-class Americans spend their entire working lives. The second way is something completely different. It's called building an asset that generates income. And this is where the real wealth building happens. An income-generating asset is something you create, buy, or build once. Then it continues to pay you repeatedly, often for years, often with minimal additional work from you. A rental property is an income-generating asset. A book you write that continues to sell. A small business you build that can eventually run without your daily presence. A software product, a YouTube channel with a mature audience, a licensing deal for something you created, a course you recorded once, a portfolio of dividend-paying stocks. All of these share one defining characteristic. They generate income that is not directly tied to the hours you worked this week. Let me make this real with numbers. Imagine two Americans, both 38 years old, both earning the same $90,000 salary, both reasonable savers contributing to their 401k. Person A follows the standard model, works hard at her job, contributes 15% to her 401k, pays down her mortgage. At 65, she retires with maybe $800,000 to $1 million in retirement accounts, depending on market returns. Her retirement income comes almost entirely from drawdown of those accounts plus Social Security. She'll be comfortable, not wealthy. Person B does everything Person A does. Same job. Same 401k, same mortgage discipline. But starting at 38, he also spends 10 to 15 hours a week for about 4 years building something. Maybe a small online business, maybe a rental property he self-manages, maybe a niche newsletter that eventually sells subscriptions. Maybe he acquires a small service business. The specific vehicle matters less than the principle. He's building a second stream. By year 4, the second stream is generating $15,000 a year in mostly passive income. By year 8, maybe $35,000. By year 15, perhaps $60,000 a year. And by the time he's 65, Person B has both a retirement account similar to Person A's, plus an income-generating asset worth several $100,000, plus a yearly cash flow that continues regardless of whether he works or not. The difference between these two outcomes at 65 is often in the range of $1 million to $2 million of total wealth. For the same starting salary, same savings rate in retirement accounts, the entire gap comes from the second lane. This is where most people get it wrong. They think wealth building in middle-class America is about maximizing what you can extract from your paycheck. It's not. It's about opening a second source of money that functions on different rules than your paycheck does. And here's the part that sits uncomfortably with the financial advice industry. Financial advisors almost never talk about this, not because they're dishonest, because their business model is built around managing money you already have. The more money in retirement accounts, the more their fees grow. There's no commission for telling you to spend 10 hours a week building a rental real estate portfolio, because that money doesn't flow through their systems. So the advice you receive from even well-intentioned advisors tends to focus almost exclusively on the paycheck to retirement model, because that's what their business requires them to help you with. The result is that most middle-class Americans go their entire working lives without ever being told clearly that there's a second path, a path that doesn't compete with retirement saving but works alongside it, a path that over 20 years does something retirement accounts alone often can't do, which is turn ordinary wages into genuine wealth. You don't need more money, you need a better plan. And the plan has to include, at some point in your 40s or 50s, the deliberate creation of at least one income-generating asset outside your primary job. Not as a hobby, not as a side hustle, as a serious, structured, patient project that eventually pays you back many times the hours you invested. Let me walk you through the 5 most accessible income-generating asset paths for middle-class Americans over 40. Not every one of these will fit every person, but almost every American over 40 could realistically choose one of them and build something meaningful in the next 10 to 15 years. Path 1 is rental real estate. This is the most traditional and, for many Americans, the most realistic path. You buy a property, you rent it to tenants. Over time, they pay down the mortgage for you, the property appreciates, and you collect monthly cash flow on top of it. Done well, a single rental property can generate a few $100s a month in net cash flow, while also building equity in the background. Done across a decade, it can produce genuine retirement income. The barrier to entry is real. You need a down payment, usually 20 to 25%. You need to handle tenants, repairs, vacancies. You need to choose the property carefully in a market where the rents actually cover the costs. But the beauty of real estate is that it forces discipline. Once the property is bought, it exists. Tenants pay you. The mortgage gets paid down whether you're paying attention or not. In many ways, rental real estate is the most set and watch of the asset paths, once the initial work is done. For Americans in their 40s and 50s, even one well-chosen rental property can eventually become a significant piece of retirement income. 2 or 3 properties, owned for 20 years, often produce more reliable monthly income than most retirement accounts. Path 2 is building a small business that can eventually run without you. This is less about starting the next big tech company and more about acquiring or building a modest, boring business that generates steady cash flow. A service business, a small online store, a specialty consultancy, a licensing arrangement, a niche product line. The key word is eventually. In year 1, you're working in the business. In year 3, you're working on the business. By year 7 or 8, the business runs with minimal involvement from you, managed by a part-time operator or hired help, and the profits flow to you largely passively. Most Americans are intimidated by this path because they imagine business ownership requires being a natural entrepreneur. It doesn't. What it requires is picking a small opportunity, working it steadily, and being patient enough to let it mature. The Americans who succeed with this path are almost never the flashy ones. They're the ones who quietly built something reasonable over a decade. Path 3 is digital products and content. This is the newest path and, in many ways, the most accessible for ordinary Americans. A book, a course, a membership community, a YouTube channel focused on something you know well, a newsletter about a specific industry, a software tool for a specific professional group. Digital products have the advantage of essentially infinite scalability with near zero marginal cost. Once you've written the book, the 100,000th copy sells just as easily as the first. Once the course exists, the 1,000th student pays just as much as the first. The challenge with digital products is that they require patience and often feel like nothing is happening for the first year or two. Most digital creators quit before they see real returns because the early period is genuinely thankless. But the ones who persist often find that by year 3 or 4, their digital products are generating recurring monthly income that continues even when they take time off. Path 4 is intellectual property and licensing. If you have specialized knowledge, professional skills, or creative work, there are often ways to license it to others for ongoing royalties. A photographer who licenses images, an attorney who creates templates for other attorneys, a chef who licenses a recipe, a designer who creates templates sold through marketplaces, an expert who licenses their course or process to corporate buyers. This path is underused in middle-class America, partly because most professionals have never thought about converting what they know into licensable assets. But the tools for doing so, online marketplaces, licensing platforms, template sites, have become remarkably accessible in the last decade. Path 5 is diversified income-producing investments beyond traditional retirement accounts. This is the most passive path. Dividend-paying stocks held outside retirement accounts, municipal bonds that pay tax-free interest, real estate investment trusts, preferred stocks, certain kinds of annuities used carefully. The advantage is that these are true passive income, no operational work involved. The disadvantage is that they require substantial capital to produce meaningful monthly income. A diversified income portfolio yielding 4% requires about $1 million of capital to produce $40,000 a year. This path is typically an add-on to retirement accounts rather than a replacement for them, and it works best when combined with one of the more active paths above. This is where most people get it wrong. They think they need to pick the best path. There is no best. There's only the path that fits your skills, your time, your capital, and your temperament. A nurse with evenings free might build a rental real estate portfolio. A software engineer might build a product. A teacher might license curriculum materials. A salesperson might create training programs. The path follows what you already are and what you can reasonably sustain for 10 or 15 years. If you fix this, everything changes. You don't need more money, you need a better plan. And the plan, at its simplest, is to pick one path, commit to it seriously for a decade, and let the asset you build become a second pillar of your retirement alongside everything else we've discussed in this series. Let me be direct about something that needs to be said, because almost nobody in the financial content world will say it clearly. Building an income-generating asset is harder than just saving more money. It takes more time, more patience, and significantly more emotional resilience. It's not the easy path, it's the harder path, specifically because it has higher long-term returns than the easy path. I want you to hear that honestly, because one of the reasons financial advisors don't emphasize this strategy isn't purely commission bias. It's also that most Americans, told the truth about what building an asset actually requires, won't do it. And recommending something people won't do is worse, from an advisor's perspective, than recommending something they will do, even if the returns are lower. So, let me walk you through the honest, emotional reality of this path. Because if you're going to walk it, you need to know what you're signing up for. The first truth is that building an asset feels like nothing is happening for a long time. You spend the first year, sometimes the first 2 years, putting in work and seeing almost no financial return. Your rental property might be barely breaking even for the first 18 months. Your digital course might sell 30 copies in its first year. Your small business might be earning less per hour than your day job. And during this phase, which can last much longer than people expect, it's very easy to conclude that the whole thing isn't working. Most people quit in this phase. This is the single biggest reason middle-class Americans don't build wealth through secondary assets. Not because they picked the wrong asset. Not because they lacked skills. Because they quit in the first 18 to 36 months. Right before the compounding started to work in their favor. The brutal truth is that the people who succeed with secondary income assets are usually not the smartest or the most talented. They're the ones who simply didn't quit when everyone else would have. The second truth is that building an asset requires you to tolerate doing work that doesn't feel like it's being rewarded in the moment. This is fundamentally different from wage work, where every hour produces an expected dollar amount. With asset building, you might spend 10 hours creating content, building systems, learning skills, researching markets, making mistakes, and nothing immediately changes in your bank account. The reward, when it comes, is often delayed by months or years. And most humans are not emotionally well equipped to do work whose reward is that delayed. This is why the people who succeed with secondary income usually have a specific kind of psychological discipline. They're able to trust the process. They can see the system working underneath, even when the outputs aren't visible yet. They're not looking for short-term validation. If you don't naturally have this disposition, you have to build it slowly through practice. The third truth is that building an asset requires you to become the kind of person who sees opportunities in places most people don't. This isn't a soft skill. It's a practical, learnable habit. Most people walk through life noticing problems around them and either ignoring them or complaining about them. People who build assets notice those same problems and start asking, could this be a business? Could this be a product? Could I solve this for other people who have it? This way of looking at the world doesn't come naturally to most of us because we weren't raised to think this way, but it's trainable. And the moment you start seeing the world this way, opportunities start appearing everywhere. The fourth truth is that building an asset almost always requires you to become comfortable with looking foolish for a period of time. You'll start a YouTube channel and have 42 subscribers for a year. You'll launch a product and make 0 sales for 3 months. You'll buy a rental property and deal with a nightmare tenant in your first year. People will ask you how your little project is going, and you won't have impressive results to report. This is part of the price. The inability to tolerate looking foolish, socially, is one of the main reasons smart adults never build anything outside their primary career. The ones who do build things have somehow made peace with being visibly unimpressive for a while. The fifth truth is that building an asset is one of the most developmentally valuable things you can do as an adult, separate from whether it makes money. You learn business, you learn marketing, you learn sales, you learn operations, you learn how to handle rejection, you learn how to finish things, you learn how to manage your own time without a boss. These capabilities compound in every area of your life, including your primary career. Most people who've built a side asset, even if it never becomes their main income, report that the process of building it made them significantly more capable in every other domain. If you fix this, everything changes. You don't need more money. You need a better plan. And the plan, when it comes to building an income-generating asset, requires you to decide in advance that you're going to commit to a decade, not to a quick win. Because a decade is about how long it takes for an asset built on the side to become meaningful. And 10 years is, frankly, a very short period of time in the arc of a 50-year financial life. Now, let me give you the structural rules that separate Americans who build successful income-generating assets from those who don't. Because even though the specific paths vary, the principles are remarkably consistent across every successful asset builder I've studied. Rule 1. Start from where you already are. The single biggest mistake people make when trying to build a secondary income is picking something completely unrelated to their existing skills, network, or experience. A middle manager who's never cooked anything impressive in his life does not start a food business. A software engineer who's never owned property shouldn't, as her first major move, buy 3 rental properties in a distant state. A school teacher who's never sold anything in her life probably shouldn't start a high-ticket consulting business. The successful path almost always builds on what you already have. Existing expertise, existing relationships, existing credibility, existing audience. A middle manager with 20 years of corporate experience might build an excellent consulting practice, serving companies at his former level. A software engineer might build a software product that solves a problem she's personally experienced. A school teacher might build a curriculum business, a tutoring program, or an educational content channel. The most efficient assets to build are the ones that compound on top of skills and knowledge you've already accumulated. This is why most people who try to escape their industry by going into something completely different fail. The learning curve is too steep, the existing competitors are too experienced, and the foundational knowledge isn't there. The better strategy is almost always to build adjacent to your existing life, not orthogonal to it. Rule 2. Keep your day job while you build. This is not revolutionary advice, but it's worth stating clearly. The Americans who successfully build secondary income streams almost universally keep their primary employment during the building phase. Not for the income, though that helps. For the psychological safety of knowing that the new thing doesn't have to succeed immediately. Desperation is the enemy of good asset building. When you need the new thing to work this month, you make bad decisions. When you can build patiently over years, you make better ones. There's a specific arc most successful asset builders follow. Years 1 through 3, you're building in your spare time while the day job pays all your bills. Years 4 through 6, the asset starts producing meaningful income, maybe 20 to 40% of your day job income. Years 7 through 10, the asset might surpass your day job income. Only then, if it's appropriate for your situation, do you even consider leaving the day job. Many never do, because the asset becomes a supplementary income stream rather than a replacement. Rule 3. Reinvest early profits into the asset, not into lifestyle. The single biggest mistake people make when their secondary income starts producing is treating the early money as spending cash. The restaurant server who starts a small Etsy business makes $3,000 in her first profitable year and uses it to buy a new television. 3 years later, she's no further along because the early profits weren't reinvested into growing the business. The correct pattern is different. Early profits go back into growth. Better tools, better systems, more inventory, marketing, help with operations, whatever would accelerate the asset's growth. You spend the first 5 years essentially reinvesting all of the secondary income back into the asset itself. Only around year 5 or 6 do you start extracting cash from it and using it for lifestyle or investment purposes. This is how a modest start turns into a substantial asset over a decade. Rule 4. Systems first, hustle second. Most beginners approach secondary income as doing more work. They just add hours to their existing life. This is unsustainable and often unhealthy. The better approach is to think in systems from the start. Every task you do in the asset building process, ask yourself, could this be automated? Could this be templated? Could this be documented so that eventually someone else could do it? The goal isn't to have a second job. The goal is to build something that eventually runs mostly without you. This mindset makes a huge difference. A rental property owner who builds a simple property management system, standardized leases, automated rent collection, a reliable handyman, a clear process for vacancies, ends up spending maybe an hour a month on a property that generates meaningful income. A rental property owner who handles everything ad hoc ends up spending 10 hours a month on the same property. The income is the same. The time commitment is 10 times different. That's the power of systems thinking from the start. Rule 5. Track everything, but not obsessively. Know your numbers. Know what your asset is earning. Know your margins. Know your costs. But don't become obsessed with daily fluctuations. Most successful asset builders check their key metrics weekly or monthly, not hourly. They know the trajectory, but they don't become emotionally reactive to short-term variations. This is similar to the principle we covered in the market crash video. Paying attention without panicking. Observing the data without being ruled by it. If you fix this, everything changes. You don't need more money, you need a better plan. And the plan, applied consistently over 10 years, takes an ordinary middle-class American and gives them something their neighbors don't have. A second pillar of wealth that grows beside their retirement accounts, quietly, reliably, year after year. Let me address something directly, because at this point in the video, many of you are feeling a specific kind of resistance that I need to name out loud. Some of you are thinking, I'm 48, I'm 52, I'm 56. Is it too late for me to start building something like this? Let me answer that question with complete honesty. No, it's not too late. In many specific ways, starting this work in your 40s and 50s is actually better than starting it in your 20s or 30s. Let me explain why, because I think this runs counter to what most people assume. First, you have more capital. An American in their 40s or 50s typically has more available financial resources than a younger person does. Some savings, home equity perhaps, professional reputation that has monetary value, network connections that can be leveraged, access to credit at better terms. A 25-year-old trying to build a rental property portfolio has to scrape together a down payment painfully. A 50-year-old often already has the down payment, or can get it through a HELOC, or through partial retirement account rollover strategies. The capital gap is enormous. Second, you have more expertise. 20 or 30 years in a career, even if it wasn't your dream career, has given you specific, valuable knowledge that can be monetized in ways you might not fully appreciate. A 55-year-old HR professional knows more about hiring, team dynamics, and workplace law than almost any book or course could teach. That knowledge has monetary value. So does the accumulated knowledge of a veteran nurse, a long-tenured sales professional, an experienced tradesperson, a middle manager who survived 3 economic cycles. The specific hard-won expertise you've developed is often the single best foundation for an income-generating asset. Third, you have more credibility. A 45-year-old with 20 years of experience in an industry has a kind of authority that a 25-year-old cannot manufacture. When a 50-year-old executive coach says she's been doing this for 23 years, potential clients trust her in ways they would not trust a 29-year-old with the same credentials. In a world overrun with young people selling services they haven't lived long enough to have mastered, maturity and experience have become competitive advantages. Fourth, you have clearer priorities. Most people in their 20s and 30s are scattered. They don't know what they want, what they're good at, or what matters to them. By your 40s and 50s, much of that clutter has cleared. You know what energizes you and what drains you. You know which projects you'll actually finish and which ones you won't. You know your values and what's worth trading your time for. This clarity is surprisingly hard to get, and it's one of the quiet advantages of middle age that nobody talks about. Now, here's the balanced truth. There are also specific challenges to building assets later in life. You have less time to let things compound. A 25-year-old who builds an asset over 10 years has 30 more years for it to continue growing before retirement. A 55-year-old who builds the same asset has only 10 to 15 years of runway. This is real. It means your strategy needs to adjust. You need to focus on assets that can reach meaningful income relatively quickly rather than waiting 30 years for slow compounding. You also have more established patterns of life that make it harder to carve out time. A 25-year-old might have lots of discretionary hours. A 50-year-old has a demanding job, aging parents, grown children who need things, a home that needs maintenance, a community they're part of. Finding 10 hours a week for a new project is a real logistical challenge. It often requires saying no to things you've been saying yes to for years. You have fewer psychological reserves for failure. This is rarely discussed, but it's true. A 25-year-old whose first business fails can shrug and try again. A 55-year-old whose first serious project fails can feel the emotional weight of that failure more heavily because they have less mental runway to treat it as just another learning experience. This is worth acknowledging honestly. But none of these challenges is a deal breaker. They're adjustments. And the successful asset builders over 40 I've encountered have all found ways to work around them. They pick assets with faster monetization paths. They carve out specific time blocks with ruthless discipline. They manage their own psychology carefully. They don't try to build the same things a 25-year-old might build. The bottom line is this. If you're in your 40s, you have a 15 to 25-year runway before full retirement. If you're in your 50s, 10 to 20 years. Both of those are plenty of time for an income-generating asset to mature into something meaningful. The question is not whether you have enough time. The question is whether you'll start. This is where most people get it wrong. They tell themselves they missed the window, when in fact the window is still wide open. They let the story of too late prevent them from taking the action that would in 10 years change everything. You don't need more money. You need a better plan. And the plan doesn't care how old you are. It cares whether you begin. Before I give you the final piece that ties everything together, and this piece matters enormously, I want to pause for a moment. If you've made it this far into the video with me, if you've sat through honest talk about the harder path of wealth building, if you're still here and still open to thinking about your financial life beyond the standard paycheck and 401k model, I want to invite you to subscribe to this channel and walk with us every single day. This is the kind of conversation we have here. Not the easy version of financial content. Not the version that tells you what you want to hear. The version that respects you enough to share what actually works over 20 or 30 years, even when what actually works is harder than what's usually recommended. And I want to say something directly. Most of the financial content you'll ever consume in your life will focus on the easy path. Save more. Invest more. Reduce expenses. Use tax-advantaged accounts. All of that is correct. None of it is wrong, but it's also incomplete. The people who genuinely build wealth in middle-class America, the ones whose retirements surprise everyone, almost always have something else going on alongside their retirement accounts. They have a second pillar. They have an asset they built. They have a stream of income that flows whether they're working or not. And almost nobody tells you about this pillar because it doesn't fit neatly into the financial advice industry's business model. What I've been describing in this video is, in my honest opinion, the single most underrated wealth strategy available to ordinary Americans. And the fact that it requires more patience, more work, and more tolerance for uncertainty than the standard path is exactly why it works. The things that are hard to do, but genuinely valuable, have very little competition. Most people won't do them, which is precisely what makes them work for the people who will. Now let me give you the final piece. The biggest secret about income-generating assets is that you only need to build one truly successful one in your entire life for the strategy to transform your financial future. You don't need to be a serial entrepreneur. You don't need to build an empire. You don't need to manage 20 properties or run 3 businesses or launch 10 products. You need to build one thing. Just one. That works. That generates meaningful income. That keeps running over decades. Most successful middle-class asset builders I've encountered have exactly 1 or 2 major income-generating assets, and those assets, alongside their regular careers and retirement accounts, are what put them into a completely different financial category than their peers. One good rental property held for 25 years can generate retirement-transforming income. One solid small business, built over a decade, can be sold for a life-changing sum. One successful book, one good digital product, one licensing deal, one acquired service business, just one, done well, can change the entire trajectory of your financial life. This reframing matters. Because if you think you need to build an empire, you won't start. It's too overwhelming. But if you understand that you just need to pick one thing, build it patiently, and let it compound, the whole project becomes manageable. 10 to 15 hours a week. 7 to 10 years of patient work. One well-chosen asset. That's genuinely all it takes. And here's the beautiful part. The asset you build becomes a legacy. Unlike your salary, which stops when you stop working, an income-generating asset keeps going. It can be passed to your spouse if you die first. It can be left to your children. It can be sold. It can continue generating income for decades after you're no longer actively involved. It becomes something real that exists in the world, separate from you, that continues to produce value for your family across generations. That's fundamentally different from what a retirement account alone can do. A retirement account is a pool of money that depletes as you withdraw from it. An income-generating asset is a machine that keeps producing. Both are valuable, but they serve different purposes. And the Americans who retire with both are in a fundamentally more secure position than those who have only one. If you fix this, everything changes. You don't need more money. You need a better plan. And the plan for this specific strategy is to pick one asset path in the next 3 months. Just one, based on your current skills, your available time, your temperament, and your capital situation. Not the best one. The best one for you. And then commit to building it seriously, patiently, for the next 10 years. Reinvest the early profits. Build systems from the start. Keep your day job while you build. Track your progress quarterly. Don't quit in the first 2 years when nothing seems to be happening. And in 10 years, look back and see what you've built. Most Americans will never do this work. That's fine, but a small number will. And the small number who do, almost without exception, end up in financial positions their peers can't understand. Not because they earned more, because they built something alongside their earning. You can be one of those people, or you cannot. The decision, as with most things worth doing, comes down to whether you're willing to do the patient work that everyone else skips. There's a scene I want you to carry with you after this video ends. Imagine 20 years from now. You're in your 60s, maybe already retired, maybe still working, but by choice, not necessity. You're sitting somewhere quiet with a cup of coffee, and in front of you there's a simple sheet of paper. On the paper is a breakdown of your retirement income. Social Security covers one portion. Your retirement accounts cover another portion through careful withdrawal planning. And then there's a third line on the paper, an income stream that isn't Social Security, isn't your retirement accounts, isn't anything that depends on you showing up anywhere. It's the asset you built. Maybe it's the rental property, still sending you rent every month. Maybe it's the small business, now managed by someone else while you receive a profit share. Maybe it's the digital products you created a decade ago that still produce royalty income every month. Maybe it's the licensing deal you negotiated, still paying out. The specific form matters less than what it represents. That third line on the page is the difference between a comfortable retirement and a truly free one. It's the piece that gives you options. It's the piece that handles the unexpected. It's the piece that lets you help your children without damaging your own finances. It's the piece that turns a functional retirement into a genuinely wealthy one. And here's the thing. That third line didn't appear by accident. It didn't appear because you earned more than your neighbors. It didn't appear because you were lucky. It appeared because at some point in your 40s or 50s, you made a specific decision. You decided that the standard path, save, invest, retire, was insufficient for the retirement you actually wanted. And you decided to build something alongside it. Patiently. Slowly, without anyone cheering you on, without any guarantee it would work. Most of your peers never made that decision. They did everything the financial advisors told them, maxed out their 401ks, contributed to their Roth IRAs, paid off their mortgages. And now, at 65, they're comfortable but constrained. They live well, but they watch the bills. They take vacations, but they calculate carefully. Their retirement math works, but there's no margin. Your math works differently because you have a third pillar. The pillar nobody saw you building when you were 45, because you were doing it quietly in the mornings before work, in the evenings after dinner, on weekends when you could have been doing something easier. The pillar nobody congratulates you for because most people don't even know it's there. But it's there. And every month it keeps doing what it was designed to do. I want to name something clearly. The path I've described in this video is harder than what most financial content tells you to do. It requires more of you emotionally. It requires patience most people don't have. It requires tolerating years of looking foolish before the work pays off. It requires saying no to easier pleasures in favor of slower, deeper work. None of that is comfortable. None of that is easy. But here's the truth. The things that actually build meaningful wealth in middle-class America are not the easy things. If they were easy, everyone would do them, and the returns would be competed away. The reason this strategy still works and still produces outsized results is precisely because most people won't walk the path. They'll stick with the easier version, which means the harder version remains available, waiting for anyone willing to commit to it. If you're in your 40s or 50s right now, you are in the window where this decision can still make an enormous difference. Not the last window, not the only window, but a genuinely valuable one. The compounding of an asset built from age 45 to 65 is one of the most powerful financial forces available to ordinary Americans. And that compounding is sitting there, unused, in the lives of most middle-class adults who've never been told it's available to them. You've been told now. The question is what you do with the information. Now, before you go, let me ask you for 3 things. First, if anything in this video shifted something in you, subscribe to this channel. Walk with us. The conversations here are going to keep going, keep building on each other, keep challenging you to think about money and life in ways the standard financial content won't. The next video in this series is going to be about what happens to a middle-class family when the primary earner loses their job in their 50s, and the specific preparation done now that determines whether that moment becomes a crisis or an inconvenience. You don't want to miss that one. Second, share this video with 5 people, 5 friends, 5 family members, 5 coworkers. People in their 40s and 50s who are following the standard path and wondering why it feels insufficient. You might be the reason 10 years from now that one of them has built something alongside their regular career. And third, leave me a comment, an honest one. Tell me what asset you've thought about building but haven't started. Tell me what stopped you. Tell me what you want me to dig into next. Every deep video we make starts with someone asking the right question. Take care of yourself. Take care of the people counting on you. And remember, wealth is not what you earn. It's what you build alongside your earning. And the building starts the day you decide to begin, not someday. This week.